any of you on the panel here have expected them to mention the coronavirus explicitly?
Not in the statement, but in the press conference, I'm sure Jay Powell will be asked about it. And I think they know that, and so that's their opportunity to comment on it, because that one is so fast moving, and none of them are epidemiologists. I mean, they're not going to be, that's not their expertise. So I think he'll want to just obliquely talk about it in the press conference rather than putting anything on paper.
Would you have expected to hear from the Fed any mention of the deficit?
I don't think explicitly, again, in the statement. I wouldn't be surprised if Powell gets a question on it. On coronavirus in particular, I do think right now it's an Asian phenomenon. So we haven't yet seen the hit to the U.S. economy, per se. And assuming the virus is contained here, we had great consumer confidence yesterday, good housing numbers. I think we're seeing that continued dichotomy between the consumer and manufacturing.
But we're starting to hear some of the drivers of the U.S. economy mention the hit they're taking to their bottom line because of coronavirus. Well,
you will definitely hear that in the multinational corporations. Think about Starbucks this morning. But on the other hand, a company like Apple is able to just drive right through it. So,
the other thing the other thing to point out is the economic language was downgraded. Household spending has been weaker. CapEx remains, a drag. And I think that's a really important thing to point out. We're at this moment where there's a lot of optimism. We got a phase one deal. People think that's going to change. That's not in the numbers yet. The numbers are downbeat, and we're at this kind of fragile moment. There's a lot of optimism, not yet supported by the data.
But I do want to point out the economy is going to grow more slowly, but that's because the supply side is also getting hurt here. So, half the job growth last year came from people over the age of 65. We're out of workers. Immigration is at a 30-year low. This economy can only grow slower. So if you see less demand, well, you've also got less supply. So it doesn't necessarily mean that monetary policy is too tight at this point. I think monetary policy is actually.
I want Steve to jump in here and take it wherever he wants to.
No, I was just going to echo the words of the previous guest there. When you look at the risks that are out there and mentioned in this statement, they all point to a risk, downside risk. There's no real upside risk here. That inflation's running below the 2% target. As the guest pointed out, business fixed investment is weak. Exports remain weak. A slight downgrade. Instead of growing at a strong pace, it's now growing at a moderate pace to household spending. So all of that is on the downside, and it's why odds on the bet of the next move, even though it's several months out, is for a cut. There really is no play for a hike here, Tyler.
So I'm going to pick up on that thought of downside risk. And obviously right now the economy is growing at the Fed characterizes it at a moderate pace. Household spending has moderate, is moderate, not strong the way it was. If the economy goes into a bit of a stall phase, a little bit of a stall, are there tools at hand now on the fiscal side and on the monetary side to get the thing going again? Does the deficit make that a lot harder? Do interest rates at their current levels make that a lot more difficult?
I think the answer is yes. The answer is that it is more difficult when you're closer to the zero lower bound. I think we've seen that in spades in Europe. They've really struggled to find ways to support their economy. By the way, if you're worried about coronavirus having an impact on trade, Europe's kind of more close to that than we are. But I think the answer is yes, is that proximity to lower bound does make this harder. It does make people more cautious. And it really highlights what Jerome Powell's trying to do, which is let's stay away from the zero lower bound. Let's keep growth and inflation positive. Let's take out some accommodative policy to make sure we don't have a recession in the United States. So it is harder, and I think that increases the urgency to stay out of recession right now.
Yeah, but these tools wouldn't work. If you cut interest rates, it's not going to speed up the economy. There really isn't any room for tax cut. But think about what's dragging on the economy. Trade rhetoric, a dollar that is too high, immigration which is too low. There are lots of things you can do to actually increase business certainty, increase global trade, increase confidence by simply being a little less erratic in terms of our trade agenda, a little bit more welcoming in terms of immigrants. There are plenty of things you can do. They're just not traditional fiscal and monetary stimulus.
So do you think asset prices are driving the economy rather than the economy driving asset prices?
I think broadly speaking, there's asset prices are a function of what's happening in underlying economic growth. Mm-hmm. But when you have enough liquidity in the system, when you have rates this low, there is this push towards risk assets. You have to go out the risk spectrum, whether that's equities, whether that's higher yielding debt, whether that's EM equities. The TINA effect is very much still in play. There is no alternative when rates are sub 175, 160 levels that we've seen, just this week.
I agree, but these are in two different paths. I mean, asset prices, this has been a rabbit of a market all the way through the last 11 years. It has boomed forward. It has been a tortoise of an economy. And, this is still going on.
Steve,
David,
jump in.
One of the things that's going to be discussed in this press conference, I imagine, is the extent to which the Fed's turnabout in its balance sheet last year is responsible for this boom in asset prices. And we know that there's concern on the Fed that if it keeps going the way it's going to fuel the bubble you guys were talking about. And there's concern on the other side that if it withdraws it and does so precipitously, that perhaps the asset prices would fall off quickly. And how to manage a real turnaround. I mean, we were down to 3.6, and now we're up at $4.1 trillion of the balance sheet and headed back, I don't know exactly where.